What's up, guys? My name is Richard. Today I wanted to share a recent investment I made into liquidity pools, the strategy and the thought process behind it, and hopefully there's some value and lessons along the way that would help you in your yield farming journey. So before we dive in, I just wanted to show you my current portfolio so you know that I put my money where my mouth is. This is a portfolio that you guys have been seeing these couple weeks. The current liquidity is worth roughly $90,000. I'm down almost $30,000 in US dollar terms because Ethereum has been down quite a lot. And my goal throughout this downturn has been to stack Ethereum. The APR is pretty decent, roughly $2,000 to $3,000 right now at this price. And you can see versus holding, I'm beating impermanent loss quite well. So I would be down $37,000 if I just held my tokens in the market. If we hop to revert, you can see my profit and loss in terms of ETH for my open positions. Most of these pools have been flipped positive here from the alts rallying, except for this ETH and Arrow pool, but this would also flip positive as long as Arrow recovers in price a little bit more. So again, my goal was to stack ETH, and then when ETH recovers in US dollar terms, then I would be in dollar profit. So the pool I invested in is actually Solana and Coinbase BTC on Solana. And the reason why I did that is because if you look here at my portfolio tracker, I updated this a few days ago, but if I zoom in here, you can see my portfolio is heavily exposed to Ethereum and NFTs on Ethereum. So I'm heavily underexposed in stuff like Bitcoin and Solana. That's why I decided to invest in Bitcoin and Solana instead of doubling down my ETH holdings even further. You could download my template down below in the comments, but basically the yellow part is where you would make edits. And the nice thing about this is that I could basically balance out my altcoin and Bitcoin exposure. So if we hop to Metrics Finance Pro, you can see here I deposit roughly $10,042. And because Bitcoin and Solana has increased a little bit, I'm up roughly 4.4% on my initial investment. And really before I enter into any liquidity pools, the question I want to ask myself is, do I believe that Bitcoin and Solana is going to be around for the next 6 to 12 months? And is it going to do well, right? There's not much to be said about Bitcoin. If you're in crypto, you're probably bullish on Bitcoin. It's the largest crypto in the world. Institutions, countries are buying it, companies are buying it. And Solana, you could argue that it has gained quite a lot of traction this bull market, and a lot of new users are actually getting onboarded to Solana. And I do like Ethereum a lot, but the reason why I want to have some Solana exposure is to hedge like people hopping over to Solana more than Ethereum. And basically when I entered the position, Solana was trading at roughly $120. Bitcoin was trading roughly at $83,000. So when I'm making a USDC investment into a crypto to crypto pool, I really want to ask myself, like, okay, in terms of US dollar terms, do I want to buy these two assets in that price, right? I'm happy to buy more Bitcoin at $83,000. Your price target might be different, right? You could still be waiting for a lower downturn. But personally, I'm happy to buy at those two prices, $120 in terms of Solana. And because my liquidity pool is made up of those two assets, right? As long as Solana is trading above $120 and Bitcoin stays above $83,000, in theory, my liquidity pool would be in US dollar profit. So that's the number one thing when it comes to entering a liquidity pool with USDC, right? Are you happy to buy at these levels, and do you believe in this asset long term? If we zoom out on the weekly chart for Solana, it looks good in terms of momentum. We have a bullish engulfing candle here with pretty high volume, but really nobody knows the future, right? If the market takes another huge dump, then Solana would probably be dragged down with it. So the max downside I'm expecting for this liquidity pool is roughly around 50%. So Solana would probably drop at most, in my opinion, roughly 50% from this current price level, roughly at $65. And the reasoning behind that is pretty simple. If we look at BNB here, so BNB is a pretty large chain, but I would argue that Solana has stronger fundamentals this cycle. But I just want to look at like the maximum drawdown on BNB last cycle. So in the bear market, BNB dropped all the way to roughly $30 billion in terms of market cap. And if we compare it to Solana, current market cap right now is roughly at $68 billion. So that's why I'm expecting a max drawdown of roughly 50%. And I'm totally fine accumulating these two assets, Solana and Bitcoin. And I do believe Solana would trade above $200 again if you believe that Bitcoin is going to trade above $100,000 again. And I'm also watching the Sol BTC chart. You could see the momentum could potentially swing back up again. And my take profit target is roughly at $200 Solana, but I'll have to see how the charts look at that time. So roughly a 1-to-1 risk ratio here, like I'm risking $10,000, I'm expecting it to go to $5,000. And if Solana bumps to roughly $200, then I'm probably gaining roughly $5,000 to $6,000 as well, not including the fees. And we're going to take a look at that right now. So here on Metrics Finance Pro, I could click on Simulate Pool, and it's going to pop out my position here. I'm using Bitcoin as the quote asset, and if I hit Simulate Position Performance, let's say I was expecting Solana to go to $200, right? And Bitcoin to recover to $100,000. So in this case, Solana has outpaced Bitcoin by a lot. My profit would only be like $3,500. But if Bitcoin was to go to roughly 11,000, you could see my profit is roughly $5,000. And if I'm in range for roughly 180 days, you can see I would gain $600 something extra in terms of fees, and it would be impermanent loss in this scenario. And if you guys don't have Metrics Finance Pro, that's fine. You could use this Desmos impermanent loss calculator here. Basically, I want to put value of deposit. In this case, I'm using Bitcoin terms, right? Bitcoin as a quote asset. So when I deposit $10,000, my position is valued roughly at 0.12. So that's the value deposit. I'm going to scroll down to prices. I put the upper range at 0.0032 and 0.00005. Price now is roughly at 0.0015628 for Sol BTC, and the price deposit is here 0.001457. And you can see here on the tracking page, this is exactly what it shows, right? Average starting price here, max price, and minimum price. Personally, I like to stay in range for a very long period of time, and I don't want to risk a lot of impermanent loss. So if you look at the Sol BTC weekly chart here, you can see 0.0005 is roughly all the way down here in the last bear market, right? And 0.0032 is here on the upside. So most likely I would be in range for quite a while. And if this pool pumps out of range, I'm totally fine holding more Bitcoin, because at the end of the day, I do want to have more Bitcoin in my portfolio. So that's why I chose those two ranges. I'm planning to stay in range for a long time. And if you see here, if the price stays at the current price of liquidity, I'm averaging roughly 12% APR, which is much higher than staking Solana, right? And if I use the custom price, liquidity moves to where it's thinner, then I could expect up to like 36% APR. And when I enter a pool, I always want to think about my worst case scenario, right? What if Bitcoin does well and Solana doesn't do well? Or what if Bitcoin doesn't do well and Solana does really well, right? So that's when the divergence loss happens, is like when the performance of these tokens differ by a lot. So here I could scroll down and see if my position dumps out of range, I'm stuck with roughly 115.6 SOL. And if it pumps out of range, I'm stuck with 0.146 Bitcoin. So you can see I mentioned that when I entered the pool, my position is worth about 0.12 Bitcoin, right? And you can see 0.146 is clearly higher than 0.12. The reason why is because if Solana is gaining in value in terms of Bitcoin over time, then my Solana is slowly getting sold into Bitcoin at a Bitcoin profit. So that's why I gain a net profit on Bitcoin terms. And if we run our cost basis here, $10,000 divided by 0.12 is what I would have, right? I mentioned earlier I entered Bitcoin roughly at 83K. So if I only have 0.12 Bitcoin and I just bought and hold Bitcoin, that's my cost basis. But if Solana outpaces Bitcoin like I think would happen, then it's 10,000 divided by this max number here. So 0.14632. You could see my cost basis for acquiring that Bitcoin drops to only $68,000. And if Bitcoin is trading above $68,000, not even counting the fees, right, then I would be in US dollar profit. So same thing if you think in terms of SOL, right? Your goal was to accumulate SOL. If this position dumps out of range, I would end up with 115.6 SOL. So I mentioned earlier I used $10,000 to enter roughly at $120 per SOL. So if I went ahead and bought like a bunch of SOL at that price, I would end up with 83.33 SOL at a $120 cost basis, right? Versus if it's 10,000 divided by this 115.6 SOL here, I would acquire much more SOL than what I had. So I would have only $86.5 as my cost basis. So as long as SOL trades above 86.5 and I'm out of range on the downside, I would still be in US dollar profit. So my goal for this particular pool is to try to get a US dollar profit. And if the market goes really badly, it doesn't matter because I could accumulate more crypto and I'm fine to wait for the market to recover. And really Solana and Bitcoin would probably be around next cycle still, right? So I'm fine holding on to my bags and just yield farming with these two tokens. And if we hop back at the Desmos here because you don't have Metrics Finance Pro, I want to click on my position. You can see the Y max is the max amount of Bitcoin I would have, roughly what Metrics Finance was showing, right? 0.14544. And then the X max is the Solana I would have at 114.98. So either scenario works out well for me because I do want both like Solana and Bitcoin exposure. And even if Solana doesn't do very well, then I'm fine holding Solana as part of my overall portfolio. So this is a strategy you could use also if you want more Ethereum exposure, if you're very heavily allocated to Solana, for example, right? You want to diversify into Ethereum and Bitcoin, then you would probably provide liquidity for Ethereum and Bitcoin. And even if it like pumps or dumps out of range on both sides, you would probably be fine with it if you wanted those two assets to begin with. And here I could simulate my impermanent loss if I wanted to. And I don't mind some impermanent loss in this pool because my goal again is US dollar profit. Even if I'm at a slight loss with impermanent loss, I'm happy to take that profit when the opportunity comes. So here at the 0.00156, you could see I only suffered 0.2% impermanent loss. Doesn't matter. Let's say it goes to like 0.0025, right? And that's like almost 10% worth of impermanent loss. And if we look at our Metrics Finance APR, obviously 12% APR is barely above that impermanent loss number, right? But if there's such a sharp move in price, I would probably expect the APR to be higher. Let's say custom price at 0.0025, right? You could see the APR jumps to like 110%, but the liquidity would probably adjust. So I won't expect 110% APR, definitely not at this level of concentration to be sustainable. So really, I would probably expect something like 30% APR over the lifetime of this pool, or roughly 20%. So as long as it's beating impermanent loss, then I'm better off in this liquidity pool versus just buying and holding Bitcoin and Solana. So here, if the price now is at the same, you can see it's 0% impermanent loss, right? If the price dumps to here, 4.7%. If the price dumps like all the way down to my bottom range, right? Obviously, that's much more impermanent loss, 32.7%. But again, I'm not too worried about it if I want both assets in the long term. And usually, if you provide liquidity for a long time, then it's very likely you're going to be impermanent loss unless you do a lot of tight range and you're rebalancing all the time. So the pros of this strategy is that there's little impermanent loss because I'm using pretty wide range here. And you can see Sol and Bitcoin a lot of times it's trading at a tighter range, so there's not a lot of impermanent loss compared to much more volatile pairs, right? So little impermanent loss, and it's full market exposure, right? Because I'm providing liquidity for crypto to crypto. If you are providing liquidity for stuff like Solana and USDC, or wrap Bitcoin and USDC, then you have USDC as the other side of the token, right? Those positions usually have less drawdown, right? Because you're pairing a lot of USDC with crypto, but your upside is much more limited. So if Bitcoin 2x in prices, for example, from this point, and Solana also 2x in price, my pool in US dollar would be worth 2 times this current amount, right? Versus having like stable coins, you might only make like 20 or 30% gain on your current investment. And I'm providing liquidity for large cap assets, so I don't mind holding these over a very long period of time. So cons, again, more drawdown compared to crypto to stable pools, and potentially lower fees comparing to what you provide liquidity for. For example, like meme coins or lower cap tokens. So that's it for the video, guys. I hope you guys got some value out of it. That's the thought process behind this investment. And we'll see how this perform, right? I don't have a crystal ball. I can't time the market perfectly. And if Solana and Bitcoin both like drop by 50%, then this position would be in pretty bad US dollar profit. But the good thing with liquidity pools is you're accumulating both assets as all of those things happen. So you're gaining more Bitcoin and Solana over the long run. Be sure to check out my video on crypto to crypto pools for a more like step-by-step guide on how to set something like this up. And there's also a lot of very important videos like impermanent loss and rebalancing that you should also watch if this is something you would like to do. Thanks for watching. I'll catch you guys on the next video.